Should be good.
Yeah. Hello, everyone. Hi there. Welcome to the 16th Annual Africa Business Conference. We're very much glad to have you here. My name is Moses Sema. I'm the co-chairs for this conference.
Hi, my name is Amaka Ogier, and I'm the second co-chair for this conference, and we're very excited to have you here. We've been preparing tirelessly for the last year, putting together this schedule, and we hope that you find the weekend to be thought-provoking.
Yeah, in this year's conference, this conference theme, Africa Accelerates, Equipping a Vibrant African Economy. The idea here is to focus on preparing for the next stage of African growth, economic growth, focusing largely on human capital development. And that means focus on skill development through education, training, and largely building sustainable job creation. And so we hope that through all the speakers, panelists, and even you all here engaging in conversation, we can have an engaging and exciting conversation about how to make that happen for the future.
Great. So it's with great pleasure that I introduce our first keynote for this weekend, Mr. Bob Diamond. Bob Diamond is founder and CEO of Atlas Merchant Capital and director of Atlas Mara Co-Invest. Bob was previously chief executive of Barclays, and prior to that, CEO of Barclays Capital, where he built the investment bank and Barclays Global Investors, the asset management division of Barclays. Bob also oversaw the integration of Barclays and ABSA's African business across 9 countries in Africa under one brand, and launched the Pan-African Corporate and Investment Bank, ABSA Capital. In 2009, ABSA Bank was recognized as the most innovative bank in Africa. Prior to that, he worked for Morgan Stanley for over 10 years. Bob is currently involved in several nonprofit initiatives. He is co-chairman globally and president of the New York chapter of Invest Africa. He is working with the Atlantic Council and Council on Foreign Relations on instituting an annual lecture on Africa with the Diamond Family Foundation, where he is a board member. The DFF received the Princeton Africa Award in November of 2013. Bob graduated from Colby College with a BA in economics and from the University of Connecticut with an MBA. He is chairman of the board of trustees of Colby College. Please join me in welcoming Bob Diamond.
Thank you so much. Thank you. Thank you for that very nice introduction, and it's a pleasure to be here to kick off such a wonderful weekend. I've seen the agenda and seen the activities that you have ahead of you, and it's going to be a great weekend. So I'd like to give 20 minutes or so of prepared remarks, and then I think the best opportunity I'd like you to think about it is I'd love to take questions and get into more of a discussion after that. So please think through some of the things that may be on your mind as I make these prepared remarks. A few years ago, my wife and I visited a village in rural Kenya. By coincidence, the village was where President Obama's father lived as a child. Like many villages in Kenya, it did not have a bank. This is not unusual in Africa. Over 80% of the people do not live close enough to a bank to have ever been in one. For as long as anyone can remember, these villagers had pooled their savings in a tin box to be used as emergency funds for those in need. Then one day, a woman named Rose asked whether she could borrow some money, not because she was in need, but because she had an idea. To her surprise, the answer was yes. She wanted to borrow the money to buy a donkey so that she could carry water from a neighboring village. She quickly discovered more demand than she had anticipated. Before long, she had 4 donkeys. She had a thriving business. With her earnings, she built one of the nicer houses in the village. More importantly, she became an example to others. Soon, other villagers began taking out loans to start businesses. The quality of life in the village slowly but steadily improved. Now, it's that story that helped convince me that the single most important ingredient in Africa's long-term economic development would be private sector growth. The fundamental enabler of that growth will be entrepreneurs. But entrepreneurs need access to capital to start and grow their businesses. Access to capital is an issue for entrepreneurs and emerging businesses no matter where they live. This problem is particularly acute in Africa. The issue is less a shortage of capital than something even more entrenched. It's about an old banking model where African banks take in deposits and invest in the country's treasury bills. The banks have traditionally been able to earn a double-digit return on their money, which is good for them and good for shareholders. It's not good for the local economy because there is no incentive for banks to mature or innovate. There is no incentive to lend to consumers and small businesses, and thus no incentive for them to support their local economies. And here's why that matters. History shows us that developing markets must have a vibrant class of small and medium-sized businesses to help diversify the national economy, create better-paying jobs, and foster productivity. This was true in the United States. This has been true in Europe. This was true in Latin America. And this is true in Asia. In Africa, these enterprises, the small and medium enterprises, generate about 33% of GDP and 45% of employment. But studies show that 70% of these businesses cannot get access to medium or long-term finance. They are often deemed too small to borrow from large banks, yet too large to qualify for microfinance. They fall into what is known as the missing middle, and as a result, there's a funding gap of about $140 billion. What's more, these businesses face huge competition on their home turf from companies throughout the world and from China in particular. These companies have easy access to finance in their home markets. As an example, Chinese state-owned enterprises venture into Africa with stapled or guaranteed financing through Chinese banks. This creates an unlevel playing field. African small and medium enterprise businesses cannot grow at home, and they certainly cannot expand abroad. Whether I'm talking to African central bankers or the continent's entrepreneurs, they all tell me the same thing. African banks need a new business model. A new business model would enable banks to support African businesses, including SMEs, and help raise incomes. According to the World Bank, there's ample evidence that deeper and broader financial systems will help move more Africans out of poverty. The good news is that regulators are beginning to force change on the banks. Nigeria's central bank has significantly raised the cash reserve ratio for holding public sector funds, treasury bills. And this should create an additional $14 billion of funding. Uganda is pursuing something similar. And I'm hopeful that other countries will see the benefits that flow from these policies and follow suit. Better technology will also spur increased lending by African banks. It says that African banks have a limited ability to deliver adequate financial services because they lack technology and expertise. Investing in technology, in risk management, and in talent will deliver huge benefits both for African banks and for the consumers they serve. There's also a public policy dimension here. If governments pursue measures to stimulate the development of capital markets and banking systems, this will help get capital to SMEs. So what do I mean here? Support for the regulatory, legal, market infrastructure that creates a climate conducive to lending and investment. And this means comprehensive bank supervision, compliance with regulation, and managing risk in financial systems at both a national and a regional level. This has worked before, It's worked before in other markets, and it can certainly work here. I care passionately about this because Africa has been a part of my life for over a decade, both for business and for philanthropic reasons. On the philanthropic side, the foundation that our family has endowed helps young people realize educational opportunities and supports organizations working to end literacy, poverty, disease, and child labor. But importantly, we also support organizations that strengthen African governments' capacity to deliver public services and promote strong political leadership. On the business side, during my time at Barclays, we acquired ABSA, the largest commercial bank in South Africa. I was able to lead the efforts to integrate ABSA with Barclays operations and retail banks across 9 other African countries. This experience showed me how well a local bank can be integrated with the local community and how well and how much goodwill this develops. I saw medical services and HIV tests being offered in local branches. I saw bank staff come together every morning before opening to pray, to sing, and to dance, all with a focus on creating better customer service. I also saw how finance could play a vital role in Africa's future growth if the capital was there for growing businesses. Recall, this has worked before. This has worked in other markets. As a result, I've recently deepened my engagement in Africa by launching a financial services platform, Atlas Mara, to guide, to drive, and to develop an African banking platform, and to serve African consumers and businesses. My partner in this venture is Ashish Thakkar, who is at Harvard today and in the audience in connection with an HSBC case study about his company, the Mara Group, one of the continent's largest Pan-African conglomerates, employing almost 10,000 people across 19 countries. Ashish is an extraordinary individual and a terrific role model of a successful African entrepreneur. I'm fortunate to be his partner, and Africa is fortunate to have Ashish as a leader. Also with me in the audience today is Jyrki Koskello. Jyrki runs all the strategy for our Africa ventures after having spent 30 years with the IFC as part of the World Bank. In those 30 years, he has experience investing in emerging markets, and in the last decade, did most of the acquisitions for the World Bank in Africa. I'd like to thank both Ashish and Jyrki for joining me today and for being great ambassadors for the Africa story. Thank you, guys. At Atlas Mara, we're investing in Africa for all the right reasons. Africa has made extraordinary progress over the last decade or so. Incomes are up nearly 40% since 1999. Life expectancy is rising, and there's renewed optimism about the future. Sub-Saharan Africa is now the fastest growing region in the world. The IMF expects it to grow at 6% this year compared to global economic growth below 4%. Many African countries no longer count as emerging markets. They have clearly emerged. My partners and I are confident that this growth will continue, and we want to help drive and support it. Services represent more than 50% of the growth in the last decade. There's a much lower average debt-to-GDP ratio than in the G7 countries, and the middle class in sub-Saharan Africa is booming. McKinsey expects consumer spending, which was about $860 billion in 2008, to reach $1.4 trillion by 2020. But another reason for optimism is enhanced regional cooperation. Governments in the West African Economic and Monetary Union are contemplating the issuance of treasury bills in the future. They have a customs union in place already, and 6 of the 8 countries have laid the foundation to introduce a common currency in the near future. Similarly, 5 nations in the East African community are pursuing currency union, while moving ahead with reforms to foster cross-border banking. Building a more unified African market will attract investment and foster both trade and growth. The regulatory climate is also improving. According to the World Bank, 45 of the 46 sub-Saharan Africa economies have improved the regulatory environment for doing business there since 2005. And 9 African countries are among the top 20 in the world in terms of showing the most improvement in business regulations since 2009. Rwanda is one of those countries, and it is now ranked 9th in the world for ease of starting a business. Last but not least, democracy is flourishing. In 1989, there were only 3 countries in sub-Saharan Africa that were democracies. By 2005, there were 24. The progress here is absolutely remarkable. All these factors make Africa a highly desirable place to invest. We have met countless CEOs throughout the continent who tell us that their plans to expand have been thwarted by an inability to access capital, at the same time that many European banks are withdrawing as they are forced to focus on building their own capital base in their home markets. So there is a huge gap opening up, and we see very attractive opportunities. Our goal in our African venture is to create efficiency in an inefficient environment. Our vision for Atlas Mara is both clear and it is simple. We want to create the leading financial services organization in sub-Saharan Africa through both mergers and organic investment. So how are we going to do that? We're going to focus on the 4 pillars that make any bank anywhere, not just in Africa, but the 4 pillars that make any bank successful. Our focus will be first on rock-solid capital. Today, few banks in Africa have adequate capital, liquidity, and funding for the incredible growth opportunity of the next decade. Second, it's about attracting the best talent. African financial services need the best people. They need the best people from within Africa and from the diaspora. Third, it's about leveraging cutting-edge technology. Technology will allow scale. It will allow growth. It will allow expansion. But technology will also allow connectivity to customers and world-class risk management. And fourth, do well and do good. Citizenship. Citizenship is about treating customers and clients with integrity, helping them create jobs and economic growth, and giving back to the communities in which our banks serve. I am optimistic about Africa's future, and not simply because of the past progress. My conversations with people across the public and private sectors, and with many of you here today, reveal a determination to build a better tomorrow. We understand that realizing our goal depends on creating a new model for banking and finance. We know what Rose knew. Access to capital can be transformative. And what the people of Africa know, the developed world's charity will not revolutionize their economies. Private enterprise will. Your attendance here today suggests that you are as optimistic about Africa's future as I. As students at Harvard Business School, soon to enter the workforce, I hope you'll be able to help more people seize the many opportunities that exist across the continent. Your energy and your talents can help Africa move into a new era defined by dynamism, enterprise, and empowerment. I applaud your focus. I thank you for your support of this special continent, and I want you to know that I am behind you. Thank you very much. I'd love to hear what might be on your minds.
So at this point, wanted to set a few ground rules for the Q&A. So as you see, we have microphones set up on each side. And so we ask that if you have your questions, you walk down and line up one at a time. One of the three things we want to make sure: one, your question must actually end in a question mark. And so it has to be a question format. Two, please leave the speeches out of your question. And then three, try and contain yourself to one question each to give us a chance to speak as well. So at this point, I invite you guys down and please come and ask questions.
Now, I'm very comfortable if we don't get questions coming out into the audience and asking the questions.
Hi, Bob. Thanks for your words. Can you speak a little bit more about your sector focus and the structure of your investment vehicle and the difference between your structure versus private equity and why you organize it as such? OB Standard Chartered Bank.
It's a great question. So we did not, first of all, just to go back to what our vision is. Our vision is very clearly to create a leading financial services organization in sub-Saharan Africa. We struggled for 3 to 6 months, Ashish and I and Yurki and the team, of what's the best way to fund that. And we actually went well down the road to raising a $500 million to $1 billion private equity fund. And the frustration, this is a bit of an overstatement, but it'll bring it to life. The frustration is that with a private equity fund, the structure is pretty much a diversified set of generally minority investments, where the timing of those investments is dictated by the LPs, not by how much time it is that the investment needs. Our eureka moment came when we realized that there was a structure where we could raise equity on the London Stock Exchange and bring not just equity, which is permanent capital to put in the businesses, but also liquidity for investors, that their timing wouldn't be dictated by certain LPs or by a fund, but the investors could come in and out and have liquidity. And then most importantly, when we thought about the acquisitions that we were interested in very few cases are the current owners who are interested in being a part of the Atlas Mara team. They see it as an opportunity to integrate with an organization that can add value to them through technology, through talent, through expansion into other markets, through capital markets, but they're not looking to exit financial services in Africa. So we have the ability to do mergers using our equity, and that keeps them in the game. So in answer to your question, there are some very, very successful private equity funds in Africa, but I have noticed when it comes to acquiring financial institutions, they are not as welcomed by the central banks and by the governments as equity, because equity is more permanent and signals that you're there for good. And then secondly, the London Stock Exchange gives us a sense of liquidity, which is very, very, very good as an acquisition currency in keeping people in the game, but it's also tremendously powerful when we're looking for international investors that they see right away that they have liquidity.
Taki Salim, Morehouse College. While there's a lot to be gained from, of course, looking at the established markets and the developed countries, what are some of the different tactics and the different lessons that you feel like you've learned being in the heights of the banking industry, and how might you apply those lessons to this new venture in Africa?
You know, I think so the question is really what lessons have we learned in large global interconnected banks and other markets, or in the global marketplace, that we can apply to Africa. I think first and foremost, it's the sense of citizenship. And we are really, really, really serious. That I think what excites Ashish and I more than almost anything else, and I know it's bad English, but I think it explains it, is being able to do well and do good. And finding an area where we can invest money for our investors and get good returns, but also have a very positive impact on the economy and the social good. And one of the things that we've done is we committed from the beginning of this that a percentage of all the rewards that come to us will go to the Mara Foundation and to the Diamond Family Foundation in the communities where we have banks. But I think it goes further than that. It's not just about giving back to the communities. I think it's also about how we will make decisions. And it goes right to the core of wanting to be a disruptive force in getting money in lending to consumers and lending to small companies. And one of the difficult things for banks in Africa has been that domestic treasury bill rates, when they're 11, 12, 13, 14, 15%, taking a deposit and investing in a T-bill rate is good for their shareholders. It is good for returns, but it's not helping the domestic economy. Now, one of the questions I pose, and I think it's a great question for everyone here, is most people in this room believe a lot of what I believe in terms of the positive economic developments in Africa, the fastest rate of economic growth of any region in the world, all the other things that we talked about. And if we believe just half of what we're all talking about over this weekend, there's almost no chance that treasury bill rates are going to stay at 11, 12, 13, or 14%. They're going to move to rates of the developed economies. And so if we don't have a disruptive force now, one, it's good, but two, we're going to have to pay the piper eventually. And if we're going to have this kind of economic growth in Africa, we're not going to be able to have that kind of a business model. So it's better, and I think what the central bank governor in Nigeria did was very astute in raising the capital ratio on holding domestic treasury bills because the intent is to try and move banks into the real economy, into lending, where they're going to, good for public policy, but it's where they're going to have to go anyway.
Hi, Ogali Gav at Harvard Business School. I guess kind of building on that, you mentioned that, a lot of banks on the continent today, they make money by investing in treasuries versus investing in the real economy. How do you see that changing in the medium to long term, or short to medium term? Do you think there's any chance of that changing? If it's just makes more business sense, it makes more sense for them to do this for their shareholders versus investing in companies?
It's one of the core questions about our vision, and why we think it will be successful is the approach we're taking of moving away from a treasury bills is going to happen over time. It's going to be forced. But it's also not moving into a direction that we haven't developed in many other markets around the world. So one of the things we're excited about is if we can just fast forward to a second, let's say we've done 2 or 3 acquisitions and we've integrated banks that are in 6 or 8 countries in different regions. We have already seen with this much more of a focus on regional trade, that trade is picking up, small businesses are doing business across more countries, and there is such an incredible demand for lending that if we can build, acquire, or do a combination of acquiring and building capital markets platforms, setting up specialized lending units with people that are deeply trained in agricultural lending, so that we can be branded as a specialist in agricultural lending or a specialist in lending against natural resources. That's going to be so attractive to the businesses that I think what we're hoping is that we create copycats, if you will, or we create such a powerful impact on the quality of banking to that sector, to small and medium enterprise businesses, that we will be part of a wave of other banks engaging in that. And so the development of capital markets is, I think about it, for small businesses, where we have ways to get more lending to them, but not taking more risk. Collateralized lending, specialized lending units, capital markets, so bonds can be distributed to institutional investors. All the kinds of things that we've seen in the developed markets is going to be so positive. The second thing is we also need the governments and public policy to support that. So if you go way back in the US to the early days of small businesses getting loans, you remember the SBA, the Small Business Administration, and the government created some credit guarantee on that to encourage banks to do it. So we're also working with international agencies, we're working with governments in Africa to create mortgage guarantee programs, credit guarantee programs in such, so that the risk of lending into the economy versus buying a T-bill is less and less. And we think, you know, there's not a single thing that we're thinking about in these areas that hasn't been developed in other markets, which makes it much easier.
My name is George Otin Atakora. I think part of your answer actually addressed the question that I have. The story of Africa obviously attracts foreign businesses, but still the local entrepreneur struggles to access capital. The interest rate today in most loans in Ghana is about 30%, making the local entrepreneur less attractive or less competitive in doing business. And the high interest rate is often based on the perceived risk or inflated risk in doing business in Africa. How do you think this inflated risk can be addressed such that the local entrepreneur can also enjoy lower interest rates on their loans?
So there's a whole bunch in that question, and I think as each of the different countries in sub-Saharan Africa continue to have stronger fiscal policies and monetary policies, get better credit ratings in the world, are able to issue bonds rather than just domestic T-bills, issue bonds to international investors. Credit ratings continue to improve, and kind of that benchmark rate, which is the domestic T-bill rate, starts to come down as more international investors have confidence in the economy and there's better fiscal and monetary policy. So that sets the benchmark of lending for other reasons. So as an example, if one can invest in a T-bill that's 13%, then that's going to drive the rate at which you're going to lend to someone else. There's going to be a benchmark there of 13%. There's other things the government can do. The governor of the Central Bank of Nigeria basically said, if you hold a T-bill, we're going to penalize you. So that also is public policy saying, okay, that option's now taken away. So if you want to invest your deposit, you have to invest it in a way different than investing in a domestic T-bill, because we're going to charge you 2 or 3 or 4 times as much capital for that. So public policy can help. Public policy can also help by providing guarantees. So if they want to encourage lending to farmers into agriculture, the World Health Organization will provide credit guarantees, domestic economies can, so that banks aren't carrying all the risk of potential failure. And then fourth, I think it's institutions like Atlas Mara. I met many people here today from Standard & Chartered, and they've been very progressive on this as well, is developing specialized lending units, capital markets platforms, and bringing in the tools and the expertise. A bank can't go from investing in T-bills day 1 to lending in agriculture day 2 without building technology, without building risk management, without building the credit tools that are necessary. And that's why, you know, I think the kinds of investments that we're going to be making and other banks are making will be good for the overall banking system. But in answer to your question, it starts with the credit quality of the country to some extent. It goes into public policy initiatives to create mortgage guarantees or lending guarantees to farmers. And then it goes into the development of more sophisticated techniques to understand the credit of who you're lending to and the ease, the capital markets platforms of doing it. But I think, and where I start out, and it goes right to the very, very heart of what I think Ashish and Jyrki and I think about when we talk about doing well and doing good, is this is incredibly important. If we can't find ways to get more money, more lending, more of those deposits going directly to consumers and to businesses, we will thwart what looks like a very positive environment for the economy. It will get choked off if we don't do it. Secondly, and I just love to think about it this way, is if we're right about the future of Africa and about the future of the economy, then interest rates are not going to stay at those levels in many countries. So we should train the banks now and the bankers now to start moving in this direction. It's so essential to get, I'm going to give one more example, and it pontificates. But if you think, it comes a little bit back to the question earlier about what have I learned from global banking that is applicable here. Think about the difference in the economic recovery in continental Europe, in the Eurozone, versus the United States. When I was at Davos a couple months ago, as an American, I was taken aback. Because as an American, I go to Davos thinking about infighting in Washington, Congress can't get along, debt ceiling, all the bad things that are happening. And I realize that all the people coming to Davos from other countries are absolutely marveling at the U.S. economy. And they're saying, you know, you guys got walloped in the U.S. by the financial crisis. You got absolutely hammered. And yet, by every measure of GNP, of stock market index, of corporate health, on every index, you're higher than you were before the crisis, and virtually every country in Europe is well below it. Your financial systems, even those, even the banks that failed, like Citibank, are back healthy and surviving. And what is the single thing that I took from that in terms of banking and the lessons learned? In Africa, in Europe today, in the Eurozone, 80% of money that goes to corporates, if a corporate needs to raise money, it comes from bank loans. 20% comes from the capital markets and institutional investors. In the United States, 80% of the money that corporates borrow come from the capital markets, only 20% from the banks. And the governments in Europe are reluctant to have capital market reform, to allow securitization, to allow all the developments in the financial markets that have allowed the U.S. that when their banks had a crisis, they didn't have to get rid of all these loans. And in Europe, the leverage of the banks is so high because they have all the corporate loans. There isn't a capital market to get rid of them. They don't have CLOs. They don't have collateralized notes. They don't have institutional investors. So it stops new lending because the government's saying reduce. In Africa, we want the U.S. model. We want to develop a capital market so that when small businesses need money, the banks facilitate it as opposed to just hold it on their balance sheet. And I think that's the big picture we want to think of is what is the best way to coordinate and facilitate and encourage a banking system that's going to allow our small businesses to continue to borrow in good times and in bad.
My question is in relation to the legal infrastructure and the regulatory environment that you mentioned about 45 countries in sub-Saharan Africa having, improved regulatory environments, and how that can permeate through the rest of Africa, and will that then mean that businesses in Africa will incur more red tape and bureaucracy?
I think the World Bank does the best study. I think, Yerke, it's every 3 years. I don't think it's every year they do it. But they do a study that is world-renowned on, which is basically, this is my words, but it basically rates countries on ease of doing business. And this is stunning. The last report showed that 45 of the 46 countries in sub-Saharan Africa moved positively. Now, I'm going to first to say some of the countries had a pretty low base. They weren't starting from as high a position, but the fact that virtually every country in sub-Saharan Africa was improving, and the fact that 9 of the 20 most positive moves were from Africa countries in the world, we wouldn't have seen this 5, 10, 15, or 20 years ago. So I think it's a very, very positive development. And I think, I don't know about everyone else here, but I find when I am in London or in the time zone of Europe, there's a lot more understanding of how much progress there has been in Africa. I find when I'm in New York or I'm in the US or in this time zone, perception still lags reality by 5 or 6 or 7 years. And I spend time on both sides, so I see it, and it's remarkable to me. But studies like this in the World Bank and things that we're doing to get equity so people aren't investing in a private equity fund which is opaque, their money's gone for 7, 8, or 9 years, but they can actually invest in equity. There's a lot of things beginning to happen where I feel that investors in the U.S. are now starting to get serious about Africa. And I think that World Bank study has been one of the key studies we've used when we visited with U.S. investors.
Hello, my name is Suhail and I'm from Morocco. I've heard throughout your speech that you said that the scope of this new Atlas Mara thing is sub-Saharan Africa. And my question is, and I see this a lot, new ventures as well as current ventures focus on sub-Saharan Africa. And my question is, why is that the case? Why is this gap between the North region as well as the sub-Saharan region isn't breached?
The simple reason is over time, we would like to be looking at a lot of regions, but if you look at the commonality of markets, then sub-Saharan Africa is very different than North Africa, which we feel belongs more in a Middle East market as a different level of maturity. But it's really only that. Within that, to be honest, when we talk about sub-Saharan Africa, we also think it's very, very, very unlikely that we would acquire a bank in South Africa, for example, because South Africa also has really, banking is already consolidated. There's only 5 banks in South Africa. A lot of the things we're talking about developing in the other markets have been developed there. It's consolidated. The premiums are very high. So in a way, South Africa, certainly from a banking environment, has emerged. So it's actually sub-Saharan Africa north of South Africa, which is our target, for all the reasons we talked about in terms of being a very positive but disruptive force in terms of encouraging lending into the economy.
Yeah, Bob, you make favorable reference to the Nigerian experience, where through a deliberate policy intervention, the governor of the central bank made it a requirement that if one is going to be investing in treasury bills, then different capital adequacy requirements would apply. The basic issue here is one is talking about different regulatory environments in the 47 or 46 sub-African countries. My question is, what is Atlas Merchant Capital doing about improving the regulatory environment that one anticipates that one should work in terms of aiming to get the kind of outcomes that you have so ably articulated?
Francis, thank you. It's a good question. I think I think it's very hard for any individual, and we're still a small business and working on our first announced acquisition. So it's hard for us individually to impact regulation. But we do what we can do with the African Development Bank, with the World Bank, with OPIC. We do what we can by being on the ground, spending high-quality time with central bank governors and finance ministers about what we're doing and what our business plan is and how they can help. And, Ashish spends more time on the ground in different countries than I do, but would give you the same story, which is that ears are wide open. It's not a mystery anymore. There is a recognition, not in every country and not at all the same degrees, of the importance in a vibrant domestic financial system. I can't think of an example of a successful economy that has ever been created without a successful domestic financial system. There is some fear, too. I do think, as many of us have seen, that the success of the state-owned Chinese companies, part of that success is that when those Chinese companies venture into Africa, they kind of have their financing wrapped up with Chinese banks. And that almost feels not fair. But we're not going to change that. The way to change that is to create an environment in Africa where your banks are getting that financing out. So it isn't a great answer to your question that I can't give you A, B, C, or D, but a big part of what we do, and I think a big part of what all of us do, is we have to spend time talking about the importance of a more mature, more sophisticated, more risk management, more technology, more capital markets platforms is all aimed at jobs and economic growth and getting more money to consumers and more money. And you know, we've talked mostly about the business side. It's very similar on the consumer side. Ashisha's company in Africa is the leading provider of IT services across Africa. And you know, a lot of what's going on with the consumer, whether it's mobile payments, we'd like to move to mobile banking from mobile payments. You know, payments is one thing from a wallet, banking is another. The incredible power of credit cards and wave and pay in terms of consumers having more access. So there's a lot that can be done with more mature, more sophistication, more technology, more entrepreneurs. I am convinced, and I would say this, of course, because we've got a different model, it's great to have private equity investment, but that's a passive investment. What we really like is getting equity and getting management skills into the banking system, and that's the difference of what we're trying to do. And it's what you're doing as well.
So I'd actually like to take this time to ask you guys all to join me in thanking Bob Diamond for a great conversation we had today. So this is definitely a great start to what's going to be, we think it's going to be an amazing weekend. But in addition, actually, for kicking us off, we actually like to give a token of our appreciation, to Bob Diamond, and we actually at this time like to again join us in thanking Bob Diamond with this gift from the Africa Business Club here at Harvard Business School.
Thank you. Thank you for having me here.